Hello guys, it's Castaway Trader and welcome back to my YouTube channel. Today's video is called The Big Picture S&P 500 and ES Mini. Please read that important disclaimer before we start. Just to remind you, this is how my website looks like. It's located at www.castawaytrader.com. This is where I strongly recommend you to create a free account so you will be notified every time I post another free update or video. And this is how my private premium chart looks like. If you want to get an extended coverage not only of futures, and if you want to get frequent updates of triple ETFs, and if you want my ongoing comments about latest developments in the market, that would be the best resource you can find in the area of products I have. I strongly recommend you to give it a try. In this video, I will be talking about directional bias. I will be talking about how you are supposed to use wave analysis to improve your trading, to increase your winning rate. And we will talk about two main counts I have now for S&P 500, and I will explain you the difference between them and the way how you can trade them. But before we start, every time you start counting something, you go to the highest possible time frame. And in this case, we will be talking about ongoing unfolding 5-wave up fractal, which is applied to a weekly time frame for S&P 500 starting off the low in 2009. And every 5-wave up fractal starts with ABC up of the low followed by ABC down, making a higher low, and we count it as wave 1 up followed by corrective wave 2 down. And this is how it looks like in S&P 500. This is what happened in the period from 2009 until 2013. We got ABC up followed by ABC down, that was wave 2 down. And once we get a bottom of wave 2, we get the strongest part of the rally in wave 3. This is wave 3, which is always subdivided into two main legs, A of 3 and C of 3, connected by a corrective pullback in wave B of 3. And let's look how it looked in S&P 500. This is the period from 2011 until 2016, and we got a very strong rally without any significant pullbacks. That was the first leg up in wave parenthesis A of parenthesis 3, which topped in May 2015. And then we got another ABC down, because under the harmonic Elliott wave, every wave is subdivided into 5 subwaves, smaller waves. And you can get A of 3 here and B of 3 here. Coming back to the model, once we get A of 3 followed by corrective B of 3, we are going to get the strongest part of the rally. This is subwave C of wave 3. Let's look how it looked in S&P 500. It started in 2016 and it topped in September 2018. And it looked even stronger than the previous strong rally in wave parenthesis A of parenthesis 3, which topped in 2015. Okay. So coming back to the model, as you can see, this method is pretty straightforward and simple. We are going to align the typical standard 5-wave up or 5-wave down model with what we have in the market. This is what we are doing right now. We are aligning the model with the actual chart of S&P 500. Once wave 3 up, the strongest part of the rally finds its top, normally we get ABC down, a corrective ABC down in wave 4 down. And a corrective wave 4 arrives when majority of bears has already given up and bailed out of the shorts. I can remind you, last summer, June, July, everybody expected for a drop. It did not come, and only at the beginning of September the correction started, when almost everybody lost hope. This is how wave parenthesis 4 down arrived. It was a quick and very enthusiastic drop, but it was structured as expected as A down, B up and C down, and as you remember, it bottomed at the end of December 2018, and since that point this is our main reference point for diving in, for zooming in into a lower time frame, because this is the starting point of wave A of 5. Let's come back to the model. This is our wave A of 5, and as you can see, it's very important to identify the termination point of that A of 5, because you're right, it is followed by another wave B down inside ABC of wave 5, and that wave B would be itself subdivided into A, B, and C. And the main question here, whether that wave A of 5 has finally topped or not. If it tapped, then we should expect a bigger pullback, which can go all the way down to 2600, something like that, just to retest those several lows. So this is the most crucial question, whether we should stay bullish or we should finally expect a bigger pullback, because a bigger pullback would mean that market would correct that whole rally started in December 2018. To answer that question, we use micro counting, which is a process of counting subwaves, integral parts of each wave. So what we know about that wave A of 5, it normally targets the previous stop made by wave 3 up here, and it has to be subdivided into 5 smaller waves. So in theory, if we count those 5 waves, and if that rally arrives at the level where the preceding rally in wave 3 stopped, we may conclude that that rally is about to terminate and a corrective wave B is about to start. Let's come back now to the two counts I showed you at the beginning of this video, and I will explain you the difference between them. This is the primary bullish count. This is my primary one. This is the one that helped me to say confidently on Tuesday early morning before open that most likely we have bottomed and we should look up the whole week last week, and that helped me and my subscribers make good money over the course of preceding week. And I kept telling them it's not time to short. Yes, the drop into Monday night looked scary. Probably many people feared that we are going to go to retest the lows made in December, but that structure saved me and my subscribers from that mistake. So the primary count assumes that the rally started in December 2018, has not concluded yet, has not topped yet. According to the rally, we should get off the low made on June 4th, we should get the final wave 5, which has to be subdivided as ABC. And so far we can only count A up, B down. That means that we have to get another rally in wave C up, and that rally at least should stretch to 3050, but most probable scenario would be to go as high as 3120 or even 3190, or maybe even higher. What I don't like about that particular scenario is that I meant that normally wave A of 5 has to target the previous top made by wave 3. So the ideal point where that wave A of 5 concluded was here. But then inside that wave A of 5, that has to be micro 3, micro 4, ABC of 5. I don't like that very small wave 4 down. It just doesn't look right. So that is why we still have chance where that wave A of 5 has not concluded yet, and it can push one more time higher before we get a bigger pullback in that wave B, which would react to the whole rally started of the low in December 2018. The bearish count assumes that we indeed have topped in wave A of 5, and the drop into Monday night was only the first leg down in the corrective wave parenthesis B down. As I mentioned again, I want to mention again that corrective parenthesis B down should be a corrective move a reaction to the whole rally which lasted several months, and what we are looking for every time is proportionality between waves. If we have a rally which lasted for 7 months, we may not get a pullback overnight, but what is even more than timing, we should get a drop comparable in size to the preceding rally. And that is why I do not like a possibility that that was the top of wave A and that was the bottom of wave B, because that ABC down in wave B down would be too small in comparison to the preceding rally in wave A. So that is why we still have a chance that wave A has not completed yet. But even if that was the top of wave A, we should get a continuation of the move lower, in parentheses B down. Now, you should ask me a question. So how your analysis could help us if you cannot give us a very certain scenario? And here I want to explain you very important stuff about how markets work. Very often we have 2 or 3 alternative counts that identify current location within the standard 5-wave fractal in different ways. Our brain hates uncertainty. This is why we love astrology, any kind of market predictions or fortune telling. This is why newbie traders keep looking for a market guru who would always sound confident and show them only one single scenario. I used to be like that. I hated when professional traders told me embrace uncertainty. I could not understand what we were talking about. I just pay you money, just give me your prediction. I know what I want to know what will gonna happen next. But a trader would leap to a new level as soon as he or she acknowledges that the market is a too complex system to be predicted. When we trade, we should not guess what the market will do. What wave analysis does is that it helps us to track sentiment of the market participants. This is why we track those fractals, because those fractals keep repeated because people's psychology are not changing. Our brains have not evolved much from prehistoric times. In other words, we measure current sentiment of the crowd to be able to predict the next trade of the crowd. Wave analysis trains you to identify and simultaneously track several alternative scenarios without pressing yourself to pick only one of them. By keeping several alternative scenarios in the back of your mind, you hack your brain. If you had only one scenario and the market moves in opposite direction, you get caught off guard. This is when fear kicks in. This is when your brain experiences the same feeling as our prehistoric ancestors did. This is flight or fight reaction. They heard a strange unfamiliar sound from outside of their cave, and they perceived it as immediate danger to their lives. In the very same way, if the market does something unexpected, you get frozen. You panic. We feel immediate danger to our positions. We are not prepared to look for a solution under pressure. When market does something unexpected, it is too late to start thinking what's now, what's next, what you should do. You have to be prepared for that outcome. When the market moves in a way assumed by an alternative scenario we have previously visualized and kept in the back of our mind, we do not feel fear, and we do not longer perceive that move as unexpected and dangerous. To improve your winning rate in trading, you avoid setups when you have one or several alternative scenarios that predict market moves in different direction. The winning trading setup is when 2 alternative scenarios predict a move in the same direction, but probably of different magnitude. When 2 alternative scenarios predict a move in the same direction, it creates a directional bias. This is where your confidence is based on. If your directional bias is up, for example, then you simply buy any bearish micro pullback on a lower time frame. Conversely, if your directional bias is down, then you simply short any bullish micro pullback on a lower time frame. Let me give you an example. This is two charts I posted on Tuesday early morning at 3:49 a.m. I'm traveling in Europe, that's why my working hours are a bit different from yours now. But probably it's convenient for many people who wake up early. So I gave them food for thoughts. I told them, look guys, the panic selling you saw on Monday night was excessive and most likely it's done. I showed them two alternative scenarios, and both scenarios pointed in one direction, which is up for several days in advance, for medium term. Let me show you. This is the bullish one. It said we are still in that wave parenthesis A of 5, and in order to get completed, we need to get another push higher in wave A of 5. This is NQ chart, by the way, 240 minutes, 4-hour chart. This is bullish scenario. In the very same update, I show them another scenario, bearish alternative. It says that basically we might have completed that rally in wave parenthesis A or parenthesis 5, and we might have started a bigger corrective parenthesis B down. But you can see that even under that bearish scenario, I said most likely the drop we got on Monday night was completion of the first leg down, and because that wave parenthesis B down anyway has to be structured as A down, B up, and C down, and A down is done, we may expect a corrective rally in wave B up. So in both cases, I said both counts expected a move higher, so we can get a directional bullish bias for several days. Now, you can say how we can apply principles of multi-scenarios analysis now. Let's come back to those two charts I showed you at the beginning of the video. The bullish count for S&P 500 and alternative bearish count. As I said, on Tuesday early morning before open, I showed two counts and I said even under the bearish scenario, we should get micro ABC of the low made on Monday night. What I meant is that under the bullish scenario, that would be wave 1 up in the final wave C of 5. Under the bearish scenario, that ABC up could be either micro 4 up with another lower push to lower low, when we will finally drop in wave B down before another rally will unfold. And this is another bearish opportunity which I showed you before on NQ for our chart. That was the first leg down that topped on Monday night, and micro ABC we got last week was micro B up of B down, meaning that we need to get another drop to a lower low under the low made on Monday, and that would be completion of a bigger wave B. Then you had a directional bias on 4-hour chart. You start tracking lower time frame charts. For example, the whole week I've been counting waves on 5-minute chart of ES mini. So here you can see my count which I started on Tuesday morning. And here you can see we, with my subscribers, successfully bought the drop, 223.6 extension, successfully nailed the bottom. So we bought many triple ETFs here, somebody bought call options. So it was a great trade when we immediately get a bounce. Here on Friday morning, I successfully nailed the very bottom of that drop. I said here it could not be that top, because we are working with A up, B down, and C up, and that C up has to be subdivided into 5 waves, 1, 2, ABC of 3. Here I said we need to get ABC down We got ABC down and it was a perfect setup. Why it was a perfect winning high confidence setup? Because we had bullish bias, and that bullish bias came from a higher time frame, from weekly time frame and from 4-hour time frame. When you have such a bullish bias, then you just wait for micro pullbacks like ABC down here, like ABC down here, and you buy them. I never chase the price. I didn't care that it kept moving high. I said, as soon as we get ABC down, I am a buyer. We got ABC down, I bought here. We got ABC down, I bought here. And even 10 minutes before close on Friday, I sent out alert to my subscribers saying that, okay, that move up of the low today, which we successfully nailed, looks like a completed subwave, micro subwave A up. Here we should get a drop in wave B down and then another push higher. And as you can see, we see resistance here at 29.45. And I kept telling to my subscribers that we should look at that resistance and we should think about other traders, how they think about that. Most likely many bears have put the protective stops here. So they think, okay, we're gonna short that market. They kept shorting that rally all the way up. When I said to my subscribers, just forget about shorts, it's too early. We should keep bullish bias. So up to that moment, I'm sure many bears still hold shorts because they were so much impressed with the drop on Monday night that they still think they're gonna make lower lows. I'm sure market gonna kill them. Market gonna make them cover those shorts on Monday or Tuesday when we go through that resistance. They would think, okay, it's gonna be another rally, and they might be right. As you can see here, I put alternative 1 up, so that ABC up under my bullish scenario is just wave 1 up. But guess what? Every time you get a completed ABC up, even in the direction of the main trend, you're gonna get a pullback in ABC down. So here you apply the very same principle. If we got ABC up in wave 1 up under the bullish count, we still gonna get ABC down, making a higher low. We're gonna get like ABC somewhere here to 25.50 or maybe even 25.25 or at least 28.90 up to that point. But we're gonna get it because the wave 3 will not start until wave 2 down has not completed. Under the bearish count, that ABC up is still a corrective wave B up before the very final drop in wave C of B down. Again, we have two very different counts, but we both imply that we're gonna get soon a move down, another ABC down. Either it will make a lower low under the low made on Monday night, or it will get a higher low somewhere in the neighborhood from 28.90 until 28.25. It doesn't matter because we will be counting microwaves, and as soon as we get completed ABC structure, that would be the time to cover our shorts. I want to remind you that I have two video courses. This is the video course, the introductory video course that would teach you the basics of the harmonic Elliott wave theory, and this is the pro course, a brand new course which I released recently, and now it has even higher, better reviews than the first course. And this is where I talk about winning rates, I talk about execution of setups, about setting stops, and about setting targets. But I would strongly recommend you to start from the first course and only then try to learn from the second course. And you can see that my first video course is a bestseller on the largest educational platform in the United States and in the world, which is called Udemy. And my new course is considered as hot and new, and it has now 4.9 out of 5 score. And if you subscribe to both video courses, you will get 20% discount with the coupon code YouTube20. I showed today the charts which I send to my subscribers under that simple micro accounts of the US indices subscription plan. It will cost you only $49.99 until September 1st, and on September 1st I will raise that price because, frankly speaking, nobody offers such a plan, such a coverage of the market for $50 a month nowadays. So my nearest competitor charges $99 for the very same coverage and less accurate coverage, I would say. And if you really want to dig deeper, if you really want to stay in communication with me, if you want to get more frequent updates, if you want to be able to request updates for any charts you want, I would suggest you subscribe to private premium chart. It costs $4.99. You will see description of the chart at www.castawaytrader.com account premium trading chart. I will post all those links in the description to this video. Thank you very much for your time. Please do not forget to like that video. Please give me your feedback and I will be happy to record more videos for you. Have a great weekend. Bye.